This is deferred tax IAS 12. It's part of your income tax. In order to prepare the financial statement, companies follow GAAP rules to get their accounting profit. However, they use the tax rule in order for them to get a portion of money that need to be paid to the service revenue for the period. As a result, the way we account for revenues, the way we account for expenses, or the way we account for income is different from the accounting perspective versus from the tax authority perspective. From the tax perspective, for example, we have to compute what we call the taxable profit or tax loss, taxable income, and that we multiply it by the tax rate to get what we call current tax payable. What is current tax payable? Current tax payable is the amount of income tax payable or recoverable in respect of the taxable profit or loss for the period. However, from accounting perspective, we compute what we call the accounting profit or the profit or loss before tax, and we multiply it by the tax rate to get what we call the income tax expense. What is an income tax expense? An income tax expense is the amount of tax payable or recoverable in respect of the accounting profit. The tax expense includes both the current tax and the deferred tax. We understood already what is the current tax, but now what is the deferred tax? We're going to see it. So, the way we account for depreciation, for example, the way we account for warranty, the way we account for bad debt, for example, from the accounting perspective versus from tax perspective are different. And that difference can create what we call a deferred tax. But we're going to go down to see that. So what is a deferred tax? A deferred tax is the estimated future tax as a result of current and past period transactions in the financial statement. To put simple, deferred tax is a tax that is payable or recoverable in the future, and it exists due to the temporary difference between accounting profit and taxable profit. Deferred tax fall in two categories: deferred tax liability and deferred tax asset. What is a deferred tax liability? A deferred tax liability is the amount of income tax that are payable in future periods because of taxable temporary differences. It is an increase in taxes payable in future years due to a temporary tax difference. Let's take an example for us to better understand this definition. We have this company that purchased a non-current asset at a cost of $30,000. And this asset is depreciated using a straight line base over 4 years. However, from tax perspective, the tax allowance is 50% year 1, 30% year 2, and 20% year 3. And the company reports 180 as profit income or accounting profit for each year. And our tax rate is 28%. Let's try to put it into a table in order for us to better understand what we're doing. You're going to realize that this, from accounting perspective, our depreciation will be 7.5. Why? When we take the 30,000, we divide it by 4 years, it's going to give us 7.5. So each and every year, we have a depreciation of 7.5. However, from tax perspective, we have 30,000. First year, it's 50%. Second year is 30%. And third year is 20%. You realize that in fourth year, there's nothing. Why? Because we have already accumulated the allowance. And if you check the difference between the tax and the accounting, is 7.5 in year 1. And in year 2 is 1.5. And in year 3, we start now reversing. Now, why? Because the tax allowance become lesser than depreciation. And remember, this one gonna have an impact on our taxable income. Let's just check quickly what is our taxable income versus to our accounting profit. Our accounting profit, remember we said it was supposed to be 180 each and every year. However, taxable profit become 172,500 in year 1. Why? Because now we're deducting more allowance. And in year 2, we deduct more allowance again versus to depreciation. It become 178. Now in year 3, we start reversing. Now we're deducting, if I may say, less allowance, which increase in a sense our taxable profit. And in year 4, the same thing. But if you accumulate the accounting profit for the 4 years, it's still giving you 720, which is the same as the accumulation or the sum of all the taxable profit per period. Now let's try to put them in the journal and let's try to see where a transaction like this gonna lead us. Remember, from the accounting perspective, we add 180 as our accounting profit. And by definition, we say from accounting profit, we calculate what we call income tax expense. How do we do it? We get the accounting profit multiplied by rate. In our case, rate is 28%. So if you take 180 multiplied by 28%, you get 5,400. However, from the tax perspective, we get what we call the current tax payable. And we said, how do we get current tax payable? By taking the tax profit multiplied by the rate. And the rate in this case is 28%. And what was the tax profit for year 1? It was 172,500. And if you take 172,500, you multiply by 28, it will give you 48,300. Now, the difference. Can you see there's a difference? Why? Because we, in our book, we're supposed to pay 50,400. But from tax perspective, they say, no, you're going to pay 48. But we know that we're supposed to pay 50. So, yes, we pay 48, but we remain with a liability that we're going to pay in the future. I don't know if you guys are seeing there. And this becomes a liability for us that we're going to pay in the future. Year 2. What happened in year 2? Still, our income tax expense did not change. It's still 5,400. However, the current tax now changed. It became 49,000. Why? Because our taxable profit is going up. And what happened to the deferred tax liability? Deferred tax liability is becoming smaller. Now we're standing at 420. And if you go in year 3, now what is happening to our deferred tax? The deferred tax is reversing now. Remember, our income tax did not change. It's still the same. 50,400. But what changed? What changed now is the current tax liability, current tax payable. Why? Because the current tax payable now it calculated based on a bigger amount, a bigger taxable profit. And the fact that the taxable profit become bigger, we are reversing our deferred tax liability. And in the last year, still the same. We reverse the remaining amount of then the balance will be 2.1. If you can just quickly do it in your mind, let's just try to draw a T account of our deferred tax liability. Remember, liability increases on your credit side. If you remember from the first year, we add 2.1 that we put as deferred tax liability. It increased on your credit side. In second year, we have 420, which increase also on your credit side. However, from year 3 to year 4, we start now putting now it's decreasing on your debit side. So it was 420 and the fourth year is 2.1. And if you do the math there, it's still going to give you a balance of 0. Hence, there's a deferred tax in this case out because the way we calculate as accountant and the way we calculate as tax, it was different, and that difference lay on the timing only. Okay. Let's talk about deferred tax assets. Say deferred tax assets are the amount of income taxes that are recoverable in future periods because of deductible temporary difference and unutilized tax losses or tax credit. It is an increase in taxable saved in future periods due to temporary difference. Let's take an example for us to understand it. Again, we have a submarine company that rents their property to Plasma Ltd. For how much? For 162 per year. So they enter a contract of 2 years. Per year, you guys gonna pay us 162. And the company have an operating expense of 70,000 per annum. However, they reported a taxable revenue of 175 in year 1 and 148 in year 2. What could be the problem in this case? So remember, from accounting perspective, if you remember revenue says that you recognize revenue when you earn it, not when you receive it. So in this case, we received 175,500. However, we only earned 162. So we received a more amount for next year. So remember, annually it was 162,000. If you take 162,000, you divide by 12, it's going to give you that annually, monthly, we're supposed to pay 13,500. However, we receive 175, which means we receive a 1 month extra in year 1 for year 2. But for accounting purpose, we only earn 162, hence we record 162. But for tax purpose, tax say, hang on, you guys receive 175. So I want to receive tax based on the 175. Okay, so we're gonna take this revenue that we have, if we have to less the expense in order for us to get accounting profit or taxable profit. So for revenue, for accounting profit, we're gonna have 162. Remember, we had an operating expense of 70,000. If you take 162 divide 70,000, you have your accounting profit or profit before tax of 92,000. But for tax perspective, we have a revenue that we recognize of 175,500 minus the expense, it's gonna give us 105,500. It is on these two amounts that we're gonna calculate the tax expense and the current tax payable. So for tax expense, it's gonna be how much? 92,000 multiplied by 28, it's gonna give you 25,760. And for tax purpose, it's gonna be 105,500 multiplied by 28, it's gonna give you 29,540. That was for year 1. Year 2, remember, from accounting perspective, we still receive the same amount. Now we're gonna receive 162 because now we earn all the money. But for tax purposes, no. Remember last year you guys pay us more, so you guys record more. So now you guys gonna record only the remaining amount. And if you go again to calculate your taxable profit as well as your accounting profit, your accounting profit is going to be 162 minus 70,000, which is going to give you 92. But your taxable profit is going to be 148 minus 70,000 is going to give you 78,000. And this 78,000 multiplied by 28 and 92 multiplied by 28 is going to give respectively a expense, income tax expense, as well as the current tax payable. Okay, again, I want to emphasize, if you take both profit before tax for the 2 years, you add them, it's going to give you 184. If you take taxable profit also for the 2 years, it's going to give you 184. But you see, what is the difference? It's just the timing difference. But the amount in simple is still the same amount, but only the timing that creates that difference. Okay, so let's put it in a journal. For our income tax expense, remember it's an expense, we're creating an expense increase on your debit side, so we increase our expense in debit side in your P&L, 25,760, which is the 92,000 multiplied by 28%. And deferred tax, now it's also increasing, it's an assets. Remember, asset, there is future economic benefits. So in a sense, why are we increasing? Because we have a current tax payable of how much? Of 29,000. We're supposed to pay only 25, but tax said no, you must pay 29,000. So we're paying now 29,000, so that in the future we're not gonna pay economic benefit of how much? Of 3,780. And in year 2 now, our income tax expense is still the same, did not change, 25,000, which is 92 multiplied by 28%. Now let's go to what's going to be our current tax payable. Our current tax payable is going to be based on 78,500. And if you take 78,500 multiplied by 28%, it's going to give you 21,980. And now, can you see now how the difference, which is now we're benefiting from the economic benefit, now we are benefiting that economic benefit now, because we're not going to be paying all 25,000, we're only paying 21,000. Why? Because now we're benefiting from the deferred tax. That's portion of the assets that we pay last period. Let's now talk about temporary differences. Temporary differences is the difference between the carrying amount of an asset or liability in its financial statement versus its tax base. Temporary differences are divided in two types. We have taxable temporary differences, which are those on which tax will be charged in future when the asset or the liability is recovered or settled. It generally occurs when the carrying value of an asset is greater than its tax base, or when the carrying value of a liability is lesser than its tax base. Taxable temporary differences lead to a deferred tax liability. Just know this. A deductible temporary difference, on the other hand, are those which will result in tax deductions or savings in the future when the asset or liability is recovered or settled. We will have a deductible temporary difference when the carrying value of an asset is smaller than its tax base, or when the carrying value of liability is bigger than its tax base. And generally, a deductible temporary difference leads to a deferred tax asset. Let's put it in a quick example. In 2021, this company received 50,000 from its client as an advance payment for the internet that's going to be used in year 22 as well as year 23. So remember, we are in 21, we receive money for a service that we're going to render in year 22 and year 23. Okay, now they say calculate the temporary difference in year 21 and determine whether it is a taxable temporary difference or a deductible temporary difference. If we go quickly to our calculation, you're going to realize that from an accounting perspective, the revenue that we're going to recognize in year 21 is a deferred revenue. However, now when we start rendering service, we start satisfying our performance obligation, then in year 22, we're going to recognize 25,000. In year 23, we're going to recognize 25,000, which gives us a total of 50,000. However, from tax perspective, we're going to recognize a 50,000 in year 1, the moment that we receive that money. Okay. So from accounting perspective, the company will recognize a deferred tax revenue in their financial statement in year 21. However, they're going to recognize a tax base of 0, because if you check your 50,000 minus your 50,000, your 0, it's going to give you a 50,000. And a deferred revenue in this case is a liability, and remember, the carrying value of a liability is bigger than its tax base. You see, if you check the tax base, it was 0, but the carrying value of the liability was bigger, and this results generally in a deductible temporary difference. And then when we go to the following slide, this is where we add that company of us that purchased a machinery. This is the other example, purchase a machinery where the cost of the machinery was 100,000 and we depreciate it for 5 years. So each and every year we have a depreciation of 20,000. However, from tax purpose, we add an allowance of 25%. So each and every year we're going to have 25%, which is 25,000. Okay, so if you check your carrying amount of the assets from accounting perspective gonna be 80,000, which is 100,000 minus 20,000. However, the tax base of the same asset is gonna be 75,000, which is 100,000 minus 25,000. Okay. Now, there's a temporary difference of how much? Of 5,000. If you check the carrying amount is 80,000, the tax base is 75,000, so there's a temporary difference of 5,000. Remember, this is an asset, and the carrying value of an asset is bigger than in tax base. In this one, we have a taxable temporary difference. Good. Now that we are done with temporary difference, let's talk now about permanent differences. What is the permanent differences? Those are once-off differences between accounting profits and taxable profits as a result of expense or income that are not allowed or taxable according to tax regulations. The permanent difference will never be reversed back or settled in the future period like those of temporary differences. Remember, for temporary difference, we say if there is any difference, that difference will be reversed in the future. But for permanent difference, there's not going to be any reverse. So why? Because the way accounting treats a specific item and the way that tax treats the same item is different and will never meet anytime now, nor in the future. Therefore, there is no deferred tax under permanent difference. Permanent difference is the result of different treatment of income or expense in the accounting base versus in the tax base. So we have permanent difference when there is no taxable income or no deductible expense. In this case, no taxable income is the income that is expenses from tax, and no deductible expense is the expense that cannot be deducted from taxable income. And the few examples that we have from permanent difference, and these are most common examples, we have, for example, your dividend income. Remember, dividend income from accounting perspective is an income that we receive. But when you go to tax, they say, no, we're not going to have tax on it, so take it out. So remember, it was an income, we increase it, but for tax purpose, we need to decrease it. Another thing, it was a traffic fund. Remember, taxing fund, for us in accounting book, we take it as an expense, we deduct it. But for tax say, hang on, you need to add it back. I don't recognize it, so you need to add it. Where, for example, life insurance, we have entertainment expenses, we have also other expenses that did not have proper invoices. That for us as a company, we recognize them as an expense. However, for tax purpose, the tax men say, no, I don't want you to recognize them as an expense. So in short, this is what we have under your permanent differences. And permanent differences is very easy, straightforward. When you read a question, you can easily pick up. However, there are also other permanent differences that can be due to a capital gain, CGT. And those one is, depending on the question that you might have, you have to be very careful if you have any CGT, and just check the portion of CGT that's going to remain permanently, will not going to change. That's going to affect as well your permanent differences. What is more complex is just temporary difference. You have to be very careful when you do a temporary difference question, because if you understand very well how to get your taxable base, I think your tax base, I think you're going to be able to do any deferred tax question. Thank you very much for watching this video. I'm going to now do a very comprehensive example so that we can see how everything that we spoke in this slide can be put into practice. Once again, if you have a question, feel free to put in the question box, And please like and subscribe to the channel so that it's a way of encouraging us. Thank you.